Let's talk more about this volatile environment we've seen over the past month, which broadly has been sort of a duck and cover situation. Joining us to talk more about this, M Plus Funds partner, Oscar Loynaz. Thank you for joining us, Oscar. So as we see this volatile environment, do you think that, and August tends to be a little dicey, right? It has been for the past several years. Are we going to see this continue into the fall? Because the elements that have provided this combustibility, they're not going anywhere.
Yeah, I mean, I think what you can bet on is volatility will continue. We went through a long phase of fairly stable markets that kind of run up on a steady basis, and the dynamics of that had changed. There's a lot of macro elements that are just bringing this volatility and uncertainty into the market, which is precisely what investors don't like. They don't like uncertainty. On the one side, you got yield curve inversions, you got a lot of recession talk from a lot of people. On the other side, you got tremendous amount of positive data coming up as it relates to the United States and positive GDP numbers and consumer fueling that. So investors just don't know what to do, and it creates a lot of uncertainty, which leads into volatility.
So you guys have a defined outcome funds. That's what you have at M+. So what role at this point should it have in a portfolio, and how does that differ from when things were sort of more stable and providing more steady returns?
So what we do, which our fund creates M+ funds, is we create defined outcome funds. And defined outcome funds, what they do is they limit the variability in terms of investments. So they may provide elements of capital protection on the downside. They may provide elements of enhanced upside, and therefore a defined period of time. So investors can safely say, well, you know, I'm going to keep myself invested in the market. I'm going to stay in equities. I don't need to move into cash or, you know, move into fixed income instruments that may tie into different risk elements. However, I'm going to define my downside. And it may be that my maximum loss may be 5%, maybe 10%, depending on the type of the fund. But the fund matures towards that particular defined outcome. And as an investor, what you've done is you've taken the potential variability into the on the market and just limit it to the particular set of returns that you're defining.
So I'll just pop in here. I'm thinking of it from cycles point of view. So one question is kind of how would that be stress tested under a sharper downturn of some sort? And the other is, I kind of think during some of those sharper downturns that assets can kind of correlate to a degree. And so how do you protect against that? Or is that an element of this?
It really isn't. Our funds are linked to a particular ETF. So they may be linked to the S&P 500 ETF or the MSCI EFA ETF. So they're really beta replacements, right? And they have one asset and one asset only, which is listed options. And the composition of the listed options leads towards that defined outcome. So during periods of distress, yes, the price of the fund will go down, its net asset value will go down, but that's just a factor of the underlying assets that the fund has. However, it will mature towards its defined outcome mechanically because that's what it's built to do. It's not dependent on, you know, active management on our side or correlation between assets. It's really the mechanics of the underlying asset.
Maturing, okay. And
when you buy the fund, do you buy it and hold it till maturity, or are you able to, I mean, is it a tradable instrument?
It doesn't trade on the exchange, but it has a daily NAV and it has daily liquidity, much like any other mutual fund. So our funds are registered. They can be bought pretty much by anybody. And they have a daily NAV, so you can liquidate it whenever you want.
I mean, I guess then to go back to Lakshman's question, is there risk in a downturn, for example, that people won't be patient enough to wait for that outcome, that they might get spooked and pull out the liquidity earlier than you might be accounting for? There
is risk. I mean, the fund can go down, right? The reality of the matter is if the fund has elements of capital protection, which the majority of our funds do, and that's really what's popular right now, it will go down much less than the market goes down because it has that buffer embedded into it. However, it's not going to stay at zero or positive if the market's going down. If the market's going down, you will lose some element in the fund if you want to liquidate and get your money that day. However, it's just protected from that potential variability.
All right, Oscar, thanks for coming in.
Thank you for having us.
Of M+ Funds.